The products and strategies needed to bring development dreams to life are influencing by the global financial environment, as development funding is a part of the property development process. But the terms of development project financing are changing rapidly, and capital is not always easy to secure. Sourcing the right funding is not an easy process, especially for those who are not familiar with the complexities of financing. Depending on the environment you are operating in, development loans may be harder to secure, and they are getting more expensive and restrictive. At the same time, in some cases pre-sales could be harder to secure, and in those cases, developers are adapting to a build-to-hold investment model. When developers are looking to longer-term investors, like debt funds and equity partners, greater transparency and accountability during development and operational management is required. The developer is expected to answer two important questions: if he could repay the loan and if the project is viable. There are several types of loans that are designed to suit each stage of the project. Land acquisition loan covers the purchase, feasibility study, development application. Construction loan is giving access to payments at each stage of a construction project, from slab to completion. Investment loan is used if the developer is renting the project instead of selling it as a long-term investment. Development finance differs from ordinary investment finance, as you can usually borrow the ongoing interest as part of the finance package. This means you don't pay interest during the construction phase, but the interest is added to the amount at the end of each stage of the project. The bank would not allow to exceed the total loan amount of each stage, and the interest is capitalized, so interest is paid on the interest. This makes development finance riskier proposition for lenders, since it is only when the developer is selling the project that he is in the position to commence repayments. How much it costs to develop a property can vary dramatically depending on the goals. But how much you can borrow is underpinned on the loan-to-value ratio, LVR. Loan-to-value ratio is equal to loan amount divided by valuation of the property. LVRs employed by banks is up to 60%, depending on the project. That means that the developer may be required to provide at least 40% of the equity to secure loan. Every bank is having its own criteria, terms, and conditions, but when calculating how much finance is needed, the developer must consider the land value, the total building costs, solicitors and legal fees, agency and marketing fees, contingency costs, completion fees and loan fees. Providing documentation to prove developers' liability to the potential lender is not always easy. The application process for large projects can take weeks and even months. Lenders will be looking at everything from reputation and track record to feasibility study and financials. Some of the information to consider are: information about the project, including a comprehensive site description, zoning, and master plan. Cash flow feasibility, providing a full breakdown of the costs, acquisition of land, taxation, professional services and sales of the final product. Show evidence of sufficient cash or equity, and of course the less equity, the higher the interest rate is likely to be. Pre-sales. Most large projects are dependent on pre-sales to minimize the mortgage risk. Providing proof about project team, builder, and professional services. Contingency, typically, 10% of the budget should be allocated to cover additional or unexpected costs during the construction project. Banks expect proof of budget and cash controls and assurance that the developer could cope with any budget blowouts. If the project is a build-to-rent investment, then forecasting a realistic operational revenues and costs to generate a total return is important, providing evidence that the projected returns meet market expectations. Banks want to be sure that they can get a return on their investment. Showing progress reports from builder and project manager and updates to cash flow forecasts, financial projections or feasibility studies based on delays and movements in the market. Bankers are expecting more than a paper calculation or a few spreadsheets. They expect financial software, like Argus Estate Master, 1-Minute FASO and more, which can be applied throughout the development life cycle. Feasibility studies can be shared with potential bankers, and underlying assumptions can be tested, offering full evidence behind every report. Once costs and revenues are input, key performance indicators are calculated, including residual land value, development margin and profit, net present value and internal rate of return, helping in evaluating development opportunities. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.